Hello and welcome back to Bunnex Investment Group. Today we are going to be talking about an expectancy technique that will definitely push you to professional trading, actually to push your trading to profitability. So this is basically a positive expectancy technique that you need. It's actually the missing piece in your trading if you are not yet profitable, and it will definitely help you. So make sure you watch till the end so that you understand, because we'll actually define step by step on how you can achieve this. So here's an important note. Please do not fall for investment schemes that come in the comment section. There are several people who are saying you can invest your Bitcoin and you will get it double after a week or so. So do not fall for that. Our only communication channels are those that are within the description box. They are just scammers on hunt. Sometimes they are actually on Telegram using the same name as Bunnex Investment Group. So only join those channels which actually originate from this specific channel. But before we jump into the war video, be sure to check out our free Telegram channel as well as subscribing to this channel so that you will not miss any new content that we upload. And those who are inquiring for the updated institutional market maker course, which will become our October class, it will be going for $210. And please note that there are limited seats as well as you need to book well in advance. So without wasting much of your time, this is what we'll go through in this video. We are going to define the accuracy in Forex trading. It's basically something that can be applied to any tradable assets, any tradable market, and then the reward to risk ratio as a technique, not just the definition of these terms. Then the most important part is the no stress trading model, and you actually need to watch this for you to make this video useful for you. So the first topic, as we defined, is the accuracy in Forex trading. And a well-known figure in the Forex world is that 90% of Forex retail traders do not succeed. Of course, this is true, and if you have been in the market for a while, you understand that most of the traders actually do not make money out of the Forex market. And some publications actually quote failure rates as high as 95%, and we've all heard the typical reasons for this such high failure rate, being lack of experience, discipline, and strategy. Of course, these are some of the major contributing factors, but the one that we are focusing on today is that successful traders actually think differently from the rest. So for you to make it in the Forex market, you need to think differently, and by thinking differently, they are actually these successful traders are not concerned with needing a high win rate. I've come across several traders who ask, "What is your win rate?" and how many trades do you win? And of course, if I tell you the truth, that you don't need to be of high accurate to actually make it in the Forex market, you would say I'm lying. But I have the backup data. At the end of this video, I'm actually going to review the model that you can follow through to actually spin the odds in your favor. And this is the exact point that we'll expand from in this video. So before we go to the model, we'll need to actually define the reward to risk ratio, as well as reveal the best reward to risk ratio that you have to follow. So the win rate in trading is completely irrelevant on its own, and many traders put way too much emphasis on the win rate. Like what I've just said, that several traders asked me, "What's your win rate?" and so forth. And these same traders do not understand that a win rate does not tell you anything about the quality of a system or a trader. So you can lose with an 80% win rate or even a 90% win rate if your few losers are big that they wipe out your winners. So we are saying probably you may have 80 trades out of 100, right? Or 90 trades out of 100, but the 10 trades from those 90 will be very big losers that they actually wipe all the winners. So then versus, on the other hand, you can have a profitable system and with a win rate, actually a low win rate of 50, 40, or even 30%, and make money way ahead than a trader who has these high win rates. So by reward to risk ratio, we are saying what you win is supposed to be very big than what you lose. So all this all comes down to your reward to risk ratio. There is a myth that says you can use a reward to risk ratio of 1:1, whereby you are risking 1 to gain 1. I tell you, in the long run, you are definitely going to crash, and the probability of that happening is certain, which is 1. So never ever fall for that. So basically, the reward to risk ratio measures the distance from your entry to your stop loss and your take profit order, and then compares the two. So one of the best reward to risk ratio is 3:1, whereby we are looking to get 3 parts of our stop loss. So if we are saying our stop loss is 7 pips, our take profit must be 21 pips. If we are saying our stop loss is 10 pips, our take profit must be 30 pips. And if we are saying our stop loss is the 20 pips, our take profit should be 60 pips. And if you say our stop loss is 100 pips, our take profit must definitely be 300 pips. So all this will need you to calculate your risk. For instance, a 7 pip stop loss uses a different lot size to a 20 pip stop loss. So that is why I always advise you to calculate your lot size using the available Forex calculators all over the internet. So you can just find any one of those calculators whereby you can calculate your lot size per trade and your lot size per asset to see if you are consistent on the amount of loss that you're having. You should have the same loss all over your trading, the same loss, the same winning, and so forth. So it can be modeled, this 3:1 reward to risk ratio can be modeled to give a very good positive expectancy technique, and that is what we are about to review. So this is basically what your trades should look like. We have a stop loss area, which is actually a third of our take profit. So this is three times our stop loss range. So if we have such an arrangement, would know that we are destined for greater success. So this is a no stress trading model which you can as well use. It's actually something that I have picked out of our one-on-one courses as well as our master classes, and you can follow this, and this only requires you to be only 33% accurate, and we are modeling this on 12 trades. So it means on your 12 trades, we are saying you are going to be winning only 4 trades. So it's 4 out of 12, meaning that 8 are going to be losers. So you are only going to win only 4 trades and lose 8 trades, right? So here the capital is X amount, X dollars. I don't know your capital. You input your X dollars within this. Then the maximum risk per trade, we are saying you are going to be highly selective. Therefore, the maximum risk per trade, the maximum is going to be 6%, and amount to risk per trade will be as well as 6%. Then the expected gain per trade is going to be 18%, since we are saying we are using 3:1 reward to risk ratio. Then the accuracy is going to be 4 out of 12, or in percentage, which becomes 33% accurate. Then the trades per month, or I don't know how long you are going to take in order for you to fulfill 12 trades. You are going to take 12 trades, and the anticipated profit for that month is 32% of X, right? So if we are going to be using $100, right, and input that $100 in this system, we are saying capital is going to be $100, then the maximum risk per trade is going to be 6% of $100, which is $6. Then $6 as well here, and then expected gain per trade is going to be $18, and then the accuracy rate will be as well 33%, and in 12 trades, then the anticipated profit on that particular $100 is going to be $32, right? So this is just a simple model of showing you that you do not need to be accurate in each and every trade. So if this was $1,000, it was going to be 320 on these 12 trades. It was, if it was 10,000, it was going to be 3.2. 100,000, it was going to be 32,000, and so forth. So the distribution of losses, for instance, we are saying we are going to win 4 trades and lose 8 trades. The distribution of these 4 and 8 trades is unknown. No one knows how these 4 trades are going to come out of the 12 trades. Maybe we are going to say win, lose, 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 win, win, win. We do not know. What we are just expecting is to reap at least 4 out of 12. So by this, we are saying that will be approximately 33 trades out of 100 trades. If we are now looking at a bigger model, or just 320 trades, 330 trades out of 1,000 trades. So we are saying if there are 330, we are going to lose 670 trades. So that is how I myself actually make money out of this game. I am not 100% accurate. I also lose like any other trader. Professional traders lose a lot of money, a lot of trades, but the small edge that they have is the one they use to actually keep themselves in profitability. So it's all about consistency, how you are going to treat your trading. Are you going to treat it as a business, as a gambling machine, or you are going to take it seriously? So this is just what I had in today's video. On that note, we come to the end of our video. Thank you for watching, and don't forget to check out our free Telegram channel. The link is right below.